started with today's presentation from Barbara O'Donovan in American Metal Market. Hello and welcome to the 2013 Copper Market Forecast webinar. We're excited to welcome Barbara O'Donovan, non-ferrous editor for American Metal Market. Barbara joined AMM in February from its sister publication, Metal Bulletin, where she worked for 4 years covering a range of metals, including gold, platinum, copper, and many more. Today, Barbara will share Metal Bulletin's 2013 forecast, including the global factors influencing copper prices, such as supply, demand, and market psychology, so you can properly plan for what 2013 may bring to the copper industry and your business. During the webinar, you can send your questions for Barbara send your questions for Barbara to answer at the end by using the Questions tab on your webinar toolbar. I'll pick those up and read those off to Barbara at the end. So with that, I'd like to turn the presentation over to Barbara O'Donovan.
Thank you very much, Wes. As Wes already mentioned, I work for American Metal Market. In case you don't know it, AMM is a paid subscription service that provides news and prices to the ferrous and non-ferrous metals industry. We have 3 channels of distribution, a daily PDF, a monthly magazine, and our website. The presentation I'm about to give to you today was prepared by our sister company, Metal Bulletin Research. MBR provides market analysis and price forecasts for the metals and mining industry. Now that's enough shameless self-promotion. I'll get down to the task in hand. So the first slide I want to show you today, provided I can get that to work. And bear with me one moment. Okay, sorry, here we go. So I'd like to start with you showing you a slide that shows the effects of quantitative easing on base metals prices. As you can see from this particular chart, it's been a dominant driver of base metal prices since the crisis of 2008-2009. Now, as you all know, the third round of quantitative easing was confirmed by the Federal Reserve in September. Now, if previous quantitative easing programs are a guide, we may expect that more price increases will come out of QE3 in the coming months. Now here in this chart, you'll see a comparison of base metal prices against marginal cost of production. The downside to prices is in theory protected by a floor close to the marginal cost of production. As you can see from this picture, you can see that copper has stayed well above its marginal cost support. That's about $2.25 per pound. Now that is why copper is in a unique position as an investor favorite. Now it also shows you that if investment or if sentiment turns particularly negative, copper is an obvious sell for investors, and it could fall a long way before reaching parity with its pure base metals. This chart shows you that copper is the tightest market of the major base metals. There is an annual supply deficit expected in copper this year and potentially a bigger shortfall in 2013. That's assuming Chinese demand recovers. Fundamentally, copper has the most attractive outlook of all the major base metals, which again makes it a firm favorite for investors. Now, funds have turned cautiously bullish on copper again since August and September. As much as we want to purely look at supply and demand, we can't ignore this effect that funds are having on copper. So when copper prices rallied from August to September, that was because short speculative positions were closed and long positions were opened. Long positions indicate an expectation that copper is going to rise in value. So the quantitative easing in the US, Europe, and Japan means greater liquidity in financial markets, which boosts commodity prices. China's commitment to new infrastructure spending also contributed to that shift towards more optimistic sentiment around August and September. If you want to look at that first chart here, you'll see that the price line, you can see that the fund positions really do pull the prices up and down. If you just look at that price line, that's the reason we have to keep looking at funds and what they're doing in relation to copper, whether we like it or not. And here you can see that fund money has continued to flow into commodities, and we actually expect it to continue to flow into commodities. The quantitative easing will ensure another up year for commodity investments, and that continues to be positive for the copper price. So 2011 was a record year. As you can see by the first chart, you see that fund money continues to increase each year, except that blip in 2008, of course. And then in the second chart, you can see the expectation for this year. We're actually expecting somewhere between $15 and $30 billion to flow in this year. Now, let's take a look at the fundamentals. The fundamentals show you why copper is so favored by investors. Low stocks and tight supply and demand fundamentals keep investors coming back into copper. So mine supply has repeatedly fallen below plan, and I think in the last 7 years, the average shortfall below plan has been almost £2 billion. So the global mine capacity utilizations, the utilization rates, they're not increasing. They're in a structural decline. That's due to the low ore grades at aging mega mines, accidents, labor disputes, strikes, etc. But we are seeing at the moment that this may now be stabilizing. That's helped by a strong rebound in Chilean production this year as new investments start to bear fruit at last. Just today, actually, this morning before I got on to you guys, some numbers came out for Chilean copper production in September, and we've seen that output from Chile has rose by about 6% in September, though I thought it was actually significant to note that Codelco's production had fallen by over 6% in the same month. Now, again, no discussion on copper would be complete without talking about funds, and neither would it be complete without talking about China. China accounts for 40% of the market, and it's the main price mover. Now, we've been watching refined copper production, and that's continued to grow strongly. It's up about 7% this year, even though scrap supply has been constrained. We can see that treatment charges and refining charges are rising as concentrate availability becomes easier. So refined production may even accelerate from current levels. Chinese imports of refined copper, on the other hand, are coming off record highs. The imports, we all watched with intrigue as these imports soared. But at the same time, we realized something strange was going on. Those imports weren't actually being brought in for consumption. They were going into bonded warehouses, with much of that metal being kind of tied up as collateral for loans to circumvent China's tight credit markets. The way we noticed what was happening was that physical premiums in China at the same time were actually declining. Now, at the moment, we're expecting that the high stock levels as a result of these imports will gradually be liquidated to feed the pickup in consumption that we're expecting as infrastructure spending accelerates. But this probably won't happen until after the changeover of power in Beijing. Substitution. It's been around for a long time. There's a lot of talk about it, especially as the copper price has gone to the record highs that it has done in the last few years. The substitution pressure for copper has not gone away. the aluminum to copper ratio continues to edge higher, which maintains that substitution pressure. With a far more bullish outlook for copper than aluminum at the moment, that ratio will continue to rise. However, the analysts at MBR tell me that the substitution is unlikely to happen in a meaningful way unless the ratio goes over 5. So we're safe for the moment. I think I've zoomed through, but I want to just bring you back to the kind of key assumptions that we're making in terms of demand. We are expecting a soft landing, a pickup in China, that is, and a pickup in infrastructure spending in the fourth quarter, so this quarter, and in the first half of 2013. In the US, we believe risks remain, but recovery still looks to be on a fairly solid footing. Europe, we continue to expect a mild recession, but policymakers will continue to muddle through, and we expect a slow recovery. Now, in terms of supply, we'll continue with an era of tight supply and mine underperformance. Some of that might be coming to an end. We're expecting that. But there is always the potential to surprise to the downside again. We never know when the next strike is around the corner, when a mine will hit an issue with production and slow the amount of material coming out. It's happened a lot last year. It's happened this year. Who's to say it won't happen again? Investors, all the reasons that they like copper still exist. So we expect them to continue to view copper favorably. But they will retain an air of cautiousness, just like we all do. We don't know what's happening going forward, but we do expect while quantitative easing continues that money will keep coming into commodities. So really what we're saying is prices are being defined by investor sentiment, which is in turn being influenced by 3 major global themes. One is the path of the US economy and the perception of the risks associated with the so-called fiscal cliff. The second is China's economic wobble. And the third is the evolution of the Eurozone crisis. So I'm just going to stop us there and take each of those in turn. In terms of the US, we've already had a commitment to open-ending quantitative easing, so that's QE3 from the Federal Reserve. And the liquidity that this will continue to provide to the financial markets will be supported to commodity prices through 2013. That's as a portion of money will be invested in these assets. Interest rates we expect to continue to stay low, which will also be supportive. Now, on the matter of the fiscal cliff, we have to assume that policymakers will ultimately make some sensible decisions and negotiate this risk. Though there are likely to be periods of heightened uncertainty along the way, which may lead to risk-off selling. Now, in Europe, rightly or wrongly, the perception is now that the situation is stabilizing relatively. Greece may leave, but not imminently, only when it is manageable to do so, and its impact will be contained. Spain, on the other hand, is the biggest worry. The region's policymakers are expected to muddle through, as they have done for the last 3 years, but real economic growth and metal demand will remain depressed for a long time. The idea that we are looking at a lost decade of growth in Europe is becoming pretty popular at the moment. From the perspective of investor sentiment and metal prices, the Eurozone, in our opinion, is not the big fear factor that it used to be. There will be sell-offs at times as investors get nervous, but overall the Eurozone should not inhibit the gradual recovery of risk appetite and hence prices. China, our third global theme, the government has pledged about 1 trillion yuan to infrastructure projects, which should underpin steady but not spectacular growth in metal demand. the imminent changeover of political power in Beijing is delaying the implementation of spending for some of these infrastructure projects, which is creating, in turn, a disappointed sentiment in the market in the short term. But we expect through 2013 to see the benefits of these investments filtering down. So that will boost prices and global sentiment and may trigger some fresh restocking. So we could be looking at more copper moving towards Asia. Outside of these regions, we're generally optimistic for a decent, but again, not spectacular growth in other key metal consuming regions. That's the Middle East, India, Southeast Asia, and Latin America. Many of these have had a wobble this year, but we do expect the recovery to materialize in 2013, which will support physical demand from those regions and investor demand for base metals again. So now the moment you've all been waiting for is the numbers, the forecasts. I've said already that we are expecting a small deficit in 2012. I apologize, I realize now I've got the number in tons there, but I think that's roughly £238,000 that we think will actually edge out to a higher number in 2013, which will be around £352,000. This is all given, that the macro and fiscal risks are addressed and that economies stabilize and that growth picks up. Reported stocks, they continue to be an issue. We continue to watch them because they represent the amount of weeks of consumption, and we are actually expecting reported stocks to fall to 1.4 weeks of consumption by the end of 2013, which is a critical low. So that's going to draw unreported, the liquid stocks out of the woodwork, most notably from Chinese bonded warehouses. That's something we can't forget, that we've got these official numbers and we can see the amount of copper in stocks, but we mustn't forget that there are unofficial stocks that are still kept out of sight and that they can be brought forward when things get really bad. So in terms of a price forecast, we're looking at a base case of $3.60 per pound for 2012. In 2013, we're looking at a base case of $3.90 per pound. There's two scenarios here. We could be looking at a bear case and a bull case. The bear case, if something happens in Europe again, things get dicey, we head more into a recession, if China doesn't have the soft landing that we're expecting, and if the fiscal cliff, that looming fiscal cliff that we're all talking about, if that happens here, then we are looking at a price for copper at $3.20, which it might be noted is still not that bad. In terms of a bull case and everything that we think will happen, I think we're relatively positive. We're looking at a bull case of returning to $4.50 per pound. So there you have it. That's our view. I'd like to just put up a slide here and give you my contact details, as well as the contact details for Andrew Cole, who is the analyst responsible for the presentation. He's made all the forecasts, so you can't blame me. And I will be happy to take any questions you might have.
All right. Thank you very much, Barbara. And just to the usual question I can address for everyone is that there is a PDF version of these slides that is available. All the attendees will be receiving a email about an hour after we close the presentation, and the last question of that survey has a link to a PDF of these slides if you want to take those back to your office and review those at a later date. So I thank Barbara for that. And once again, if you have any questions, go ahead and send those in. We are also, the Copper and Brass Service Center Association is always looking for more webinar presenters. If anyone would like to do a presentation on a copper manufacturing technique and application of your products, anything really. We're open to those presentations, and our members have responded very well today. So I think we're looking at a really good attendance number. Credit to Barbara on that one too. So if anyone, if anyone has a question, go ahead and send those in. I'm not seeing any at the moment, but I'm sure everyone just needs a moment to take that in and get us a question.
I've stunned you all into silence.
No, that's it. They just need a minute to type, that's all. So here we go. Here's the first question. Here we go. Will the deficit in the copper market be skewed to the first or second half?
At the moment, I believe we're talking about the first half. We're looking at a continuation of the deficit that we're seeing here at the end of 2012, and that continuing and possibly getting a little bit worse in the first half of next year.
Okay.
From what I'm told, it's looking up for the second half of next year.
Okay, thank you. Next question. How much lower do you think copper, currently at $3.60 a pound, how much lower do you think copper would be if not for all of the money printing by governments?
I think that probably does make a big difference. The money printing per se that's going on and that increased liquidity that they are providing to the market is definitely increasing the activity of funds in copper. Having said that, while it might mean that a few investors would not invest, I don't think they would go away completely if those actions were to stop. For the reasons that I said during the presentation, the raw basic supply demand fundamentals for copper are really good from an investor point of view, and they were late getting to it, but they've all now realized, and given that things aren't going to change in the foreseeable future, I think it'll take a lot more to scare them away. As in terms of an exact number where I think the price would be without the actions of the government, I can't actually say. It's very hard to isolate, but I do think it would go lower, but not significantly lower.
All right, well, thank you very much. And then this question has actually come in more than once. Folks are wondering where additional mine production might come from, if anywhere.
Well, yeah, at the moment we are looking at an increase from Chile, which is the historical miner of the world. Now, there are areas, though, that have got much better supplies. So at the moment, to put it in terms of context, the mine ore grades in Chile have been depleting for years. So that's why it's decreasing. You have to go further down underground to get that metal out, and the metal that you're looking at is of a grade of less than 1%. Now you have much better copper in areas like the Democratic Republic of Congo. There are some mining activities taking place there, but it is what one would call a politically unstable country to operate in. So it's not as easy as saying, oh, look, there's 4% copper in the ground in the DRC, let's go in and get it. It takes time. On average, it takes 10 years to get a mine into production.
Yeah.
So we were looking at the DRC and Mongolia. There's a big copper project at the moment, Oyu Tolgoi, that seems to be moving along. There is some uncertainty about whether the government wants to take bigger stakes, or there is issues of royalties in all these countries, but that's one of the biggest ones on plan at the moment.
Yeah, and that leads right into the next question we're getting here. Specific copper mining regions that are there some that are more volatile this year than maybe last year, and what regions might be the most stable 2013, both politically and from a production standpoint?
Yeah, I think when you're looking at the regions, Africa is the area where we are all looking for new mine supply to come out of. I don't think the volatility there at the moment is markedly different to, for next year. It's not going to be markedly differently to what it was this year. This year has been the year where governments have stepped up and said, hey, we want a piece of that cake if you're going to have it. And that will probably continue. So that volatility within Africa will remain. I think volatility in terms of production from South America, I think that we are seeing signs that is stabilizing. Production has increased out of Chile already. That will probably continue to increase because we've had years of investment going in there, and it's taken a while, but we're beginning to see the difference now. So possibly less volatility in South America, same volatility in Africa.
Okay, excellent. Okay, and then getting into another topic here, will tin prices soften or lower in 2013? A concern is tin is a component of copper alloys and plating on copper materials.
To hand, I don't have a forecast. I'll have to go to our analyst at MBR to say, what's he thinking. I'll gladly get that and send that out to anyone. I know at the moment there is some concern about supply of tin. If that were to continue, then the logical assumption would be that prices would increase. But we all know very well that tin can move very quickly in either direction, sometimes when we least expect it. So if anyone wants to send me an email and I can get my hands on some more concrete forecasts, I'm happy to provide that.
Oh, perfect. Okay. Did your outlook involve both virgin and scrap copper availability in the marketplace? If not, do you have any comments on the outlook of scrap availability?
At the moment, I believe the number forecast that MBR has provided is looking mostly at primary copper, but we will always be looking at scrap because it is a big component of the price. Obviously, if the price goes so high, people switch to scrap. In terms of supply, we're not hearing anything saying that the supply is going to greatly diminish. There are some things like Hurricane Sandy that will have an impact that will bring probably more copper supply in the early first quarter of next year. That's probably very regional. Obviously, in New York, we've already seen an increase in aluminum scrap as a result of Sandy, but copper will take a little bit while longer to come in. So there are some day-to-day things that will change that supply, but we're not expecting a big increase or decrease in scrap supply next year in comparison to this year.
Okay, we've got another question here. Would DRC copper be considered a conflict material, and would that not affect consumption of this source?
At the moment, I'm trying to think whether it has been classed. As far as I'm aware, but I have to give a little bit of a preface here and say I could be wrong, it hasn't been classified as a conflict mineral. There is obviously always the potential that something could happen. It's more likely in likes of tin, where you have a lot more artisanal mining going on in the DRC, so they're really trying to clamp down on the really poor conditions that people are operating under there. But in terms of copper, the producers that are in there, we've got a lot of big producers in the DRC at the moment, and they're operating well within the sights of the government. They have to operate within certain standards, so the likelihood of their copper being branded as conflict minerals is unlikely at this point.
Okay, excellent. We've had great questions, great responses from Barbara, and I know everyone appreciates you offering up your contact information there if they ever have any questions and responses to that. And as you know, you are a magazine editor, reporter, so you always want to hear from people out there in the business. Am I right?
Absolutely. You know, the information we get is you know, the information we have is only as good as the information we get. So our main thing is to keep talking with everyone from all facets of the industry, and that's how we get a good rounded picture of what has happened and hopefully of what will happen going forward.
Yeah, that is great. One more question it looks like here. If the government is putting their hands in the pot, will that add to a higher 2013 price forecast for copper from the slides they were just viewing? Or were the slides including the government getting their share? Let me see if I can read that one more time. Did you understand?
Give it to me one more time. It'll give me time to digest the question.
Hold on, get back up here. Okay. If the government is putting their hands in the pot, will that add to a higher 2013 price forecast for copper from the slides we were just viewing? Or did the slides include the government getting their share, or were the slides without the government getting their share, I guess is what it boils down to.
Yeah, I think we have, you know, factored in what we see as what could happen in the U.S., fiscal cliffs, government taking their share, etc. So we have built that in. I guess you would look at the bear and the bull case. We're, you know, depending on which way you look at it and what they do, we've kind of provided a floor and we've provided a ceiling. And yeah, I think you can safely say that's built in.
Okay, excellent. Just want to remind everybody there, we do have, CABSA does have a webinar series planned for the 2013 year with a educational series on metallurgy. It would be an excellent series for folks just entering the industry who may have a business and sales or commodities type background. They can learn more about just metallurgy itself and understand the products we're talking about out here. Keep your eyes open for that. It's a whole series using some of the members are stepping forward to put together those presentations, and as you know, our members have a wealth of experience and very experienced and professional members we have. So just want to remind everybody about that. I don't see any more questions here, Barbara, but we did have some good questions there and great presentation from you. So if there are no more, I'd like to say thank you to Barbara O'Donovan. And if you are interested in, once again, if you're interested in doing a webinar, you can contact Carly Rogers here at the CABSA office. She is the Education and Marketing Manager. You can reach her by hitting the staff listing on copper-brass.org, and you can get her email and phone number and everything right there. So thanks again to Barbara, and I think that is, yeah, sorry, keep an eye out for the survey. It's coming in about an hour. So I guess that's it. Thank you, Barbara.
Thank you too, Wes.
And then we do that.